Hey there, everyone. Welcome to the Final Bar. It's Tuesday, March 19th. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. We're going to use the Stockcharts platform today, as we always do, to try to make sense of these markets. Focus on thematic moves, focus on what's working and what's not working, really leveraging the power of Stockcharts and the power of technical analysis to understand and appreciate the movements as they're happening around us. We have a fantastic guest, by the way, Chris Ciovacco of Ciovacco Capital Management, a longtime Stockcharts user, and does one of the best that I've seen at looking at long-term time frames and helping to navigate through periods of market dislocation, market uncertainty. Who better to have on the show in this particular time when a lot of questions have been raised about the longevity or the sustainability of this bull market phase? I think you'll enjoy, hopefully, my conversation with Chris Ciovacco here in a moment. Before we get to that, let's kick off with our market recap. Let's talk about how the markets have evolved over the course of today's trading session. Before we do so, I do want to let you know about a poll we had on our social media accounts recently. What do you think the Fed does at this week's meeting? As you hopefully well know, the Fed meeting today and tomorrow. Tomorrow, we have the latest update on Fed policy at 2 p.m. Eastern. At 2:30 Eastern, we'll have Powell's press conference. I think many investors, they should be, will be hanging on Powell's comments about potential trajectory for Fed rate policy changes through the course of this year into next. 88% of you expected rates to stay the same. Low single digits suggesting a raise or a lowering. Market's certainly pricing in no change at this particular meeting. It's going to be less about an actionable change tomorrow and going to be more about the dot plot, which is the expectations that the Fed governors as a group have about Fed rate cuts or changes in Fed rate policy in the coming months and even years. I think a lot of expectations will be maybe changed. We'll see as we get Powell's comments. With that in mind, let's keep going here with our market recap. The major averages not having too bad of a day. Usually going into a two-day Fed meeting, preparing for that announcement tomorrow. Usually a quieter session, usually a little lower volume. And it's sort of easy going. Today was actually a pretty interesting day in that we gapped lower at the opens. The S&P opened around 51.35 in the first 10 minutes, but then through the course of the day, I actually had a pretty decent run of things, closing just around 51.80, just below that level. That's up about 0.6% from Monday's close. The Nasdaq composite was up a little less, up 0.4%. The Dow was actually up 0.8%. So sort of a value over growth, generally speaking, kind of day. Mid caps and small caps all in the green. The S&P 600 small cap index was up 0.7%, and the only red you have on the front page is the VIX, which is down about half a VIX point, so down to around 1380. So the VIX obviously below that 15 threshold, which is that back of the envelope level that I like to follow to see, is this a low volatility environment or not? And as long as the VIX remains below 15, I think it's pretty straightforward that we are in a low volatility environment. I have an alert set for if and when, and probably more when, the VIX spikes above 15. It's happened a couple times in the last couple weeks, but it really hasn't held. Right? We kind of come back to that low volatility, low teens kind of range for the VIX. Interest rates overall drifting lower today. The 10-year yield finished just below 4.3%. The 5-year yield around the same point, and the long bond yield a little bit higher, around 4.44. So bond prices and interest rates certainly something to watch after going into tomorrow, but really after tomorrow's session, because it's going to be all about expectations about Fed policy. It's going to be about anticipating changes in inflation and what expectations might be, what the Fed will do, how long they might keep rates fairly elevated in terms of the short end of the curve that they're controlling to continue to bring inflationary pressures down or alleviate some of those higher inflation issues. So we'll see what sort of rates movement we have, but for now, the 10-year yield getting back below 4.3%. The dollar index up about 0.25% from Monday's close. Precious metals moving lower, so you have the GLD down 0.1%, silver down 0.5%, copper prices down 1.7%. The energy part of the commodity space mostly in the green. So you have crude oil prices using the USO, which is a crude oil ETF, up about 0.6%. Natural gas prices up about 2%. Boy, cryptocurrency is not doing particularly well here recently. After Bitcoin pushing up into the mid-70s, it felt like Bitcoin 80,000 was not too far away from where we're at. Now it's getting further and further because Bitcoin's coming off quite a bit. Just in the last little bit here, We have Bitcoin down about 6%, down about 3,900 points to 63,700. Ether prices are just below 3,300. That's down about 7%. You can see all 10 of the most liquid coins that we track on the Stockcharts platform, all in the red right now. And that's been a trend here. We'll look at the chart of Bitcoin here in a bit if we can. Looking at the 11 S&P sectors, you can see energy leading the way higher. Utilities actually spent much of the day on the top of the leaderboard, but energy just eclipsed it going into the close there. So energy number one up 1.1%. Utilities, consumers, discretionary, and industrials all kind of tied for number two, up about 0.9%. You had a couple sectors that were basically flat for the day. Nothing really lost ground today, but communication services, the XLC, real estate, and materials were essentially flat from Thursday's session. Going down here to a group of stocks I call the Magnificent Seven and Friends. These are 8 mega cap growth names. You can see Tesla, which has been one of the worst performers, actually by far the worst performer, down about 30% year to date, down another 1.4% today. Alphabet and Meta both in the red as well. Apple, Nvidia, Microsoft, all up about 1+% here. So leading the way higher of this group of mega cap leadership stocks. Let's go to a daily chart of the S&P 500 and see where things played out and how that has impacted our rapidly ineffective trend lines, I guess is how I would describe these. You know, and again, not that trend lines are broken or anything. It's just they're not particularly, the market is not particularly holding well to the trend lines that I keep drawing. And maybe there's a message there. And what it tells you when you keep drawing trend lines and they keep breaking, but we're not really breaking down. We're just sort of, the slope of this trend is easing off. I think it speaks to sort of a slowing, a maturing of that trend, if you will, sort of showing that even though we keep making higher highs and higher lows, the pace of that rise is declining. And the way that you can tell this visually on the chart is one of the benefits of using what's called a semi-logarithmic scale or a semi-log scale is basically percentages, like a 1% on this y-axis is consistent. So 1% down here is the same distance as 1% up here. That's an important thing I would encourage you always to do, which is basically select a log scale instead of arithmetic scale. Arithmetic scale, $1 has equal treatment. And the problem is as you get higher, those dollars have less percentage moves. And so it kind of compresses the data as the price gets higher. Log scale means the slope of a trend line is a consistent percent return. So you can actually draw a line that has like a 6% monthly return or 6% annual return. You can actually see how closely the stock is following or ETF is following that consistent percentage rise, which is why when trend lines are broken on a semi-log chart like it is here, it usually means something. It usually means that a consistent return is now starting to change. Now, we've had a number of these little breaks, and most recently, this blue trend line on the bottom was taking the October low, connecting that with the mid-February low, the early March lows. Now, all of a sudden, we've broken this a couple times, and we've not really had any follow-through. What I mean by that is we've closed below that level, but then immediately the next day, we're trading back above it. Even today, we opened down here well below trendline support, but closed back above it based on how I'm drawing this particular line. So, you know, we're not going up as aggressively as we were maybe like in January, but we're not really going down. We're just sort of going up less, I guess is the way that I would describe the S&P. Now, what's interesting is, as always, I like to define a line in the sand, right? That level where you'd feel comfortable setting an alert and saying, hey, as long as the S&P holds above 50-50, regardless of how choppy it is, like it's just not that bad, right? And I think 50-50 for me is that line in the sand. This is a pivot point that we've tested a number of times. For now, of course, we're well above that level with a higher move today, but that's where I have an alert. I would encourage you to think about what level makes sense for you based on the time frame that you're operating on, and wait for that signal. That signal tells you you need to revisit it. Also notice, it's interesting to me, the last time the RSI was below 50 was all the way back here, just coming out of the October low. So think of that, right? After that October low, around 4,100, we had the initial move higher. The RSI pushed above 50, basically the first trading day in November, and we haven't even touched that level that whole time since. And even though we're seeing some divergences, right? The S&P, the Nasdaq 100 have both made new highs in March on weaker momentum. The momentum isn't getting too negative, and I think that's important here. It's strong but not excessive. So get nervous when the RSI starts breaking below 50, starts breaking below 40. That would be the real warning sign for me. For now, it's telling you things are kind of hanging in there just about okay. I do want to speak just briefly about breadth indicators, looking at the McClellan Oscillator, which is my favorite kind of short-term momentum gauge. This is not yet updated for today's close, and I'm interested to see if we do dip back above the zero line. But end of last week, we actually finished the week below zero, and that for me is a short-term breadth indicator. And that's what the McClellan Oscillator is really designed to do, right? Tell you short-term breadth shifts and whether these short-term breadth conditions are positive or negative. Positive is shaded in green when the indicator is above zero. It's shaded red when we're below zero and the breadth conditions are more negative. For up until Monday's close, we were certainly below the zero line. Today was a nice bounce higher, and a lot of stocks were up. So I'm wondering, we'll see if we do break above the zero line. All that would tell me is that the short-term breadth has now started to improve. Again, as of Monday's close, still a little more negative than positive. Let's switch gears a bit here and look at the chart of Bitcoin. When we're talking about Bitcoin, again, not too far off of some pretty serious all-time highs. Bitcoin broke above 70,000 for the first time. This was just a couple weeks ago. It feels like the last week has been there's been a lot happening here. Let's look at the last year, just kind of zoom in a little bit. So we saw sort of this consolidation that we had in spring, summer of last year, and then October was just this beautiful breakout above that base. And if you ask me why I pay attention to things making breakouts of big bases, here's your case study among many, right? A lot of times that big breakout out of a basing pattern. A basing pattern is like a big rectangle on the chart. When you finally have enough upside momentum, enough buying power to push above that base after an extended period, that usually means it's not the end. It usually means that's just the beginning of this next big move higher. And you can see that that is indeed what has been happening. We've had a fairly consistent pattern of higher highs and higher lows, and that's the kicker, right? Even though we've pulled back quite a bit, even though just in the last 24 hours we've pulled back all the way down to almost 62K, we're now just above 64,000 as we're recording the show here, and that's down from 74,000. So it's a full 10,000 points lower for Bitcoin just in the last week or so. But also note that we keep making higher lows, and even with this drop, I think holding that 60,000 level, that's why I have that line drawn. Big round numbers tend to be pretty important for something like Bitcoin. When we break above one of these levels, I want to make sure we hold it. So the fact that we didn't hold 70,000 is not particularly great, but holding 60,000, which would hold us above that swing low in early March, I think could be pretty important. The 50-day moving average, by the way, all the way down here around 56,000. So that if we do break 60K, that's where I would probably look for additional support. But overall, still kind of hanging in there okay. The pullback scenario would mean probably a little bit of further downside. The RSI stabilizes sort of between current levels right at 50 and down to around 40. You see that the pullback in January of this year kind of had that idea, right? We pulled to a big round number, 40,000. The RSI stalled out around 40 and then rotated higher. I'd be looking for a similar kind of setup. And if you could get that, that could be a great sign of stability and maybe the next higher low pushing to a new high there. We break 60,000. I think you have to really question the downside potential in a chart that has really started to struggle here in the short term. Just to finish off, let's look at some individual names that are in the news or on the move today. Alphabet, one of the worst of the Magnificent Seven, not a horrible day. It was down about 0.4%. But what's interesting to me, looking at the candle chart, actually, if you look at the short term, I'm seeing a gap higher yesterday. This was Monday's session, right? So we finished Friday. Thursday, we closed above the 50-day moving average. Friday, we closed back below. Monday's session yesterday, nice gap higher from the close around 141 on Friday to opening around 148.50. We traded up to 152, but by the close, we're back at the lows of the day. And this is called a shooting star candle. Think about why that's called it. It makes sense, right? If you look at the picture, you gap up. The open and close are near the lows of the session, but you have this long upper shadow, as it's called, which is basically the intraday high. So at some point, we traded all the way up to 152, but closed all the way back near the lows. And that's a short-term reversal candle telling you more likely than not the short-term trend is down. I was just emailing with Steve Nissen yesterday. His name came up on one of my conversations in New York, and had a good exchange with Steve. And Steve always reminded me that, remember, the candle charts have built-in risk levels. And what I mean by that is there's a natural stop that's built into something like Alphabet, right? This one-bar pattern, the shooting star candle, you basically assume that the short-term move is lower, which is what we're seeing today, But also, if we get above 152, that would negate that bearish sign, right? Because if we can get above the high of that day, that tells you the shooting star candle did not work. You want to sort of go back, risk on, and expect further upside. But after that gap, it's been two solid candles, two filled candles, which suggests weakness rather than strength on the intraday sentiment. I want to look at the chart of Amazon because a lot of those growth leadership names are showing some clear bearish momentum divergences. That is a phrase I love to throw around, which is where the price keeps going higher, but on weaker momentum. So is Amazon going down? It absolutely isn't. Is it going up? Technically, I would say it still is, but has something changed? And I think that's what the RSI changing direction may indicate, right? When a market is going higher, you want that uptrend to be met by stronger momentum because that means buying power is in control. Buyers are overwhelming sellers, however you want to think about it. But overall, the price is improving and the momentum is thumbs up positive. When the price keeps going higher on weaker momentum, that usually indicates we're at the latter stages of that particular uptrend and you start looking for signs of a breakdown. So I think we've seen that bearish divergence play out. We've not really seen the drop yet. So I think looking back to the 50-day moving average, looking back to the February swing low, that's around 165. This stock gets down to 165. That's about 10 points below current levels. That would be a broken chart, at least in the short term, telling you, further downside risk is increasing. For now, it's just sort of holding up, and I think you want to watch charts like this to see if the divergence does play out. I do want to point out a chart of Nasdaq NDAQ. This is one of the biggest gainers, top 10 stock in the S&P today, up almost 4% and had a nice move to the upside. I didn't have time to check out what news or if there was something particular that happened with NDAQ. But again, regardless of what you think about the overall market, regardless of what you think the S&P and the Nasdaq are doing or what they are inclined to do, I would argue it's always a good time to own good charts and stocks making higher highs and higher lows. Stocks breaking out of bases after pulling back and making higher lows are encouraging. And I think that's something that we're seeing here. Last chart for our market recap. There are also some strong names out there. This is a stock that looks a lot like a semiconductor. It looks a lot like a growth name. It's actually a utility company. Now, this is NRG, which is bucketed under utilities, but just look at this consistent uptrend. The weekly chart tells an even better story. Look at this sort of sideways pattern until the fall of last year, breaking out of that resistance and then just really continuing to the upside. It's a great reminder that regardless of what you think, I think too many people make a market call, I'm bullish or bearish, and then think about whether or not they want to own stocks. I would focus on charts that are working, and it's always a good time to own good charts. That's our market recap for today, sort of hitting on some of those key movements. Of course, the Fed meeting tomorrow, today and tomorrow, and then the announcements tomorrow afternoon are really going to be an area of focus. So I'd expect a quiet session until around 2:30 Eastern. That's when things will really accelerate. So we'll look forward to tomorrow's show, recapping what happened with the Fed meeting and what sort of aftermath we can piece together. Before we bring on today's guest, Chris Ciovacco, just one quick announcement. It is to encourage you to send in your questions. The Final Bar mailbag has been getting some great questions from all of you, really thoughtful questions about technical indicators, about particular stocks and ETFs, so much more. So keep them coming. TheFinalBar@Stockcharts.com is our email. You can also tag us in a comment at FinalBarSCTV on the X platform. And here on YouTube, just drop a comment below the video that you're watching, and we would love to get your questions for our next mailbag session. All right, I want to welcome on today's guest, Chris Ciovacco. Chris is the Chief Investment Officer at Ciovacco Capital Management, coming to us from Atlanta, Georgia. Chris, great to see you again. Welcome back to the show.
Happy to be back, Dave.
No, it's good to see you, and it's been too long since you've been on here. I hope we can get a good cadence of sharing some of your insights and your expertise with our audience. We're starting with the chart that you and I talked about almost a year ago. This is back in April of 2023. Can you talk us through this monthly chart of the S&P 500, what it told you or what it tells you about sort of the overall market structure there?
What it told us in April of last year was, when we came off of the October low, the question was, is this a bear market rally? Is this the real thing? And momentum, especially centerline type momentum, you could do something similar with RSI. This is TSI. They're all very similar. And what you were hoping was, if you were a bull, was that the present day in April of 2023 didn't morph into something that looks like 2002 or 2008, where momentum price fails at a 200-day moving average, and momentum can't recapture that center line.
Mm.
And when we were on in April of last year, what it told us was price action holding at an upward sloping 200-week moving average, and the fact that we were able to recapture that center line, it was looking less and less like a bear market rally and more like the low was in the rear view mirror and we were reestablishing a long-term or secular uptrend. And that was when the S&P was at 4,100. And the takeaway there is a lot of bad things happened between now and then. We had a 10% drawdown. It wasn't a straight path up over 5,100. We didn't go up 1,000 points. And that's somewhat of the takeaway of these type of charts. They're helping you with the long-term trend. And why that is helpful is when you get the 20% drawdown or the 14% drawdown, it helps you keep an open mind about, look, we've still got this upward sloping 200-week below us. We shouldn't be too bearish here, and we should at least try to figure out what's going to happen. And if you go back to the 2001 case and the 2008 case price-wise, you can see that the market pauses there and it hesitates. It's not simple. So when you're coming off of that low in October of 2022, you can't just assume that everything's going to hold. But the further you get away, and that centerline cross of momentum really is a differentiator. You can see that didn't happen when we had those failed bear market rallies.
Really interesting. And this is a weekly chart of the S&P you're showing. And I love, really clear differentiation between some of these cyclical bears during a secular bear, right? That really frustrating period versus what happened after the '09 low, after the financial crisis. And really, I'm glad we were able to revisit that, Chris. I think there's a brilliant signal there. Fast forward to where we're at now in March of 2024. When you're looking around you, what do you see? How are you making sense of things here?
So we're using very similar concepts here. So remember, we're talking here about very long-term trends. So when I was on in April of last year, we still had a 10% correction between that period and where we are today. So you don't want people to take away that if we're in a secular trend or the long-term trend is up, that the stock market is green every day, it's green every week, it's green every quarter. It's what you just said. The difference is when you look at these charts, if you start in the 1950s on the left side of the chart, price action and the strength of the trend, which is measured by the Chande trend meter on the bottom, it's pattern recognition, basically. During the bull market, the market tends to make a stand near the upward sloping moving averages, price action. And the trend has a tendency to hold on the meter on the bottom at logical areas. And then you can see when we move into what I like to refer to as a secular period of stagnation, all of that changes. You don't hold at the moving averages anymore. The trend meter starts to go into areas where it's never been before. And why is that helpful? That's telling you during the 1950 to 68 bull, your pie chart or your allocation might look one way, and it might be more of, I'm going to be aggressive with market leaders and I'm going to try to ride out volatility. And then when you get to the secular periods of stagnation, you're probably not going to be as aggressive with risk, and you would want to diversify. And when you get to those periods, defensive assets are going to start to outperform logically, and your pie chart's going to change, your allocation's going to change, and you're going to have a different way that you manage things during the periods of secular stagnation and during a secular bull. And the moral for today is the pattern is very, very clear. It looks like we're still in a secular bull market, and we don't use that to predict. We use that to assess probabilities, just as we did a year ago when it said, hey, the odds are starting to tell us we should be open to this market, maybe doing better than some expect here. And we're still in that mode. And if it doesn't hold, if we start to break that pattern, we'll still learn something about how we should be managing assets and what we should be doing with our allocation.
It's such a great set of charts. This is a monthly chart that we're looking at, Chris, and thanks for bringing this along with you, because it's a great just illustration of the difference between secular bull periods and, as you described, secular stagnation, which I think is a great way of labeling it. So given the fact that we're obviously in a pretty strong long-term phase, in the short term, it's felt like things have gotten a little less comfortable, a little choppier as we've sort of had a lot of noise around sort of the S&P 50/50 to 5200 sort of range. What do you do in a period like this, particularly when it feels like there's a little bit of confusion, a little bit of uncertainty? How do you sort of navigate through this? Is it just staying focused on the long-term trends and looking for evidence there? Or what's your approach to sort of thinking about these short-term fluctuations?
One of the advantages of managing money is a lot of times you'll get someone that will give you a big chunk of cash. So you've got to decide, how am I going to handle that? So what that does is that forces you as a money manager to look at shorter term time frames. Should I be funneling this money in now, or should I be waiting? So you're going to take your time frames down. You know, an 8-day moving average may be relevant at that point. And I think really what we want to try to understand now is this just healthy rotation where tech and our semiconductors are pausing and maybe treading water for a while? Or are we going to have something where XLE energy, due to fears of inflation rearing its ugly head again, starts to outperform tech significantly in the intermediate term, which is exactly what happened during the 10% correction in the second half of last year? So far, it looks like those moves have been relatively muted, and we don't have a leadership change yet. So we're trying to ride things out and hold. But if the evidence changes, and again, during a secular trend, you can get very large drawdowns. If the charts start to shift a little bit more, it's possible we might take some more money off the table. We've taken a little bit off of semiconductors, but for the most part, are sitting pat because that's what the charts are saying. And obviously we get some big data points coming tomorrow with the new dot plot for the Fed.
Tell me how you approach a week like this in particular. As you mentioned, we've got the Fed meeting today and tomorrow. Tomorrow, I'm sure Powell's press conference will be a lot of attention on what sort of expectations we have about Fed rate cuts. How are you thinking about Fed rate policy through the course of this year? How does that inform your decisions now in terms of positioning?
I think it's really interesting because we've had a big shift. So we've gone from a period in our careers where we had a secular downtrend in interest rates from the early 1980s, and that really probably flipped in 2022. And in some respects, that's really good that we're talking about inflation, because that means stronger economy. That means we've got issues. We don't have any demand problems right now. We have supply problems. And during a big chunk of our careers in the rearview mirror, we were always trying to stimulate demand. There wasn't enough demand for the capacity that we had. So this is a symptom of a healthy economy. And I think the good news is, for most of us, is the Fed is always important. The Fed is always really important. But I don't think the Fed is as important as it was between, let's say, the financial crisis and 2018 is really where all of that starts to flip. The market's very confused. You have a 10% drawdown, then almost a bear market in Q4 of 18. Then you have COVID, and that's where interest rates flip. So Fed, very important, but probably not as important as things used to be. And that kind of goes back to the breadth thrust topic. When the Fed used to switch gears, that used to trigger breadth thrusts, and that was very, very reliable in that window. I think breadth thrusts are still relevant, but they're maybe not the binary light switch timing tools that they used to be, because we're not in an environment where the Fed is going from we're not market friendly to we're 100% market friendly. Those days are probably over, and it's more of a blend between the economy, inflation, interest rates, and Fed policy.
No, it's really well put, Chris, and thanks for laying it out that way. We've got about a minute left, and I'd love to ask you, what sort of things would you need to see to, it sounds like you're still overall fairly offensively thinking about this market, right? Sort of overall thinking, innocent until proven guilty, for lack of a better term. What would you need to see to get you leaning more defensively? Would it be an improvement in defensive sectors where we really haven't seen much improvement yet, things like utilities or maybe staples? Or is it more some of the models we highlighted earlier really starting to break down and tell you this is more of a risk-off environment? What's sort of your go-to indication that, okay, we need to take more risk off the table than we've done so far?
I think the first thing you want to determine is, are we going to risk off because of fears of a recession? That's a deflationary event. If it's fears of inflation, that's an inflationary and interest rate driven type event. So we're modeling both of those, but I think the one to be more concerned about, obviously, is inflation at this point.
Yeah.
So I've got a chart list that literally shows how these things evolve during that 10% correction. One of them would be what you're talking about, something like SPY divided by XLP. You can look at something like SPY divided by SHY, which is almost cash when people get really defensive. XLK divided by XLE is another really good one. And as you mentioned, we don't have enough evidence to get overly concerned at this point, but that can change very, very quickly. And there's no doubt that your leaders are taking a break. And the one that I think you should watch is if you take XLK and divide it by XLE, especially on shorter term timeframes, XLE is really starting to do some things that do look like the early stages of that correction. It was a little early then, but it's just something to keep an eye on. It hasn't moved far enough to warrant any action at this point, but it has moved far enough to warrant paying closer attention.
I feel like we're starting to see maybe some of those early signs, not enough to confirm it yet, but I really like that take on that ratio, tech versus energy. That's a great one, Chris. I wish we could keep doing this for hours because it's such a pleasure, Chris. And listen, thanks for bringing some great long-term charts with you. As always, appreciate your perspective and your calm focus at paying attention to these markets. Thanks for coming on today.
I appreciate the invite, and it's always great to catch up. Keep up the great work.
That's Chris Ciovacco. Chris is the Chief Investment Officer at Ciovacco Capital Management. Again, what a pleasure to talk to someone like Chris, managing assets, really trying to answer questions about positioning and about offense versus defense. And he's not just talking the talk, he's literally putting bets on for his clients' portfolios. Some of those ratios at the end, I'm jotting down as he's talking. I don't know if you can see, but off camera, I'm sort of jotting some ideas down. Something like tech versus energy, different things about sort of growthy offense versus more value-oriented ratios. Really interesting way to think about potential rotation here in March of 2024. Great take there, as always, by Chris Ciovacco of Ciovacco Capital Management. Folks, we've got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I mean, what a great conversation with Chris Ciovacco. Really love his longer term charts. Inspired me to look at the last sort of 4 or 5 years on the S&P 500. Just think about what I would call a Fibonacci framework. Fibonacci retracements I like to bring on occasionally, and this is something that really helps me and I think could help you. Just think of a structure for the market, right? Anytime you have a big move to the upside or the downside, Fibonacci retracements can often be applied to help you think about what the subsequent moves really mean and what levels may or may not be important. I've highlighted from the 2020 low to the 2021 peak, how we pulled back to around 38.2%, eventual low here around 3,500 was almost perfectly a 50% retracement of that rally. You can see when we pulled down in the first 10 months of 2022, we then rallied to right around 38.2% of that decline, around 4,000. We then hit the 50% level and then finally broke above it. And you can do this on multiple time frames in different levels. You'll notice anytime there's a big run higher and we pull back, that 38.2% level is usually like a minimum downside objective after that move. The reason why I'm putting that here is if you do think that the market has topped out and you're thinking about what's the downside potential, it's very interesting to me that if you take the October 23 low and the March 2024 high, if this ends up being the ultimate high, 38.2% of the way down would be right around 4,800. Look how well that lines up with the previous all-time high at the end of 2021, beginning of 2022. So sort of a market symmetry potentially and a potential drawdown objective if we do get more of a risk-off move. And I don't think we've seen it necessarily enough to confirm that yet. Chart number 2 is looking at Amazon. Again, just a friendly reminder. I think times like this are a perfect time to use the annotations on a platform like Stockcharts to really focus on key levels, what I call a line in the sand that you want to pay attention to. For stocks that you own, if you have a portfolio of stocks or ETFs, put those tickers in Stockcharts and go through and put these lines at the key levels you want to follow for each one of those names. Set an alert for each one of those price levels as well. And then have a regular process where you review your charts for potential breakdowns. Use the alert engine as a way to automate that and have the platform tell you when to look for, when to maybe take some risk off the table. Amazon and stocks like this, growth leadership names, many of them have shown bearish momentum divergences, but we've not really seen a price breakdown. That would be focusing on some of those potential levels of support. Also, I just want to point out Super Microcomputer. When I heard the news that they're going to be added to the S&P 500, the first thing I think of is that's probably the end of this rally, because I've seen it so many times. When a new ETF gets announced, it's usually because some theme has played out so much that it's probably the end of the move. When a company that has had an exponential rise finally gets added to a major benchmark, that usually means whatever happened to get you there is probably starting to near the ending point. This is March 4th. This is when the news hit that SMCI was added as a new S&P 500 member. We drifted a little bit above there over the next week, but overall, that was not a bad time to sell the stock for now, because this was the day it actually was formally added. This was on March 18th, yesterday's close. You can see that was one of the biggest drawdowns we've had looking back at the last 6 months on SMCI. So we'll see if we're able to find some footing, but I did want to point out, this is one of those, buy the rumor, sell the news. When the news actually hits, and when you see the growth has been so strong that something like the S&P 500 becomes an option for a stock like SMCI, it usually means that move is near its end. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. Special thank you to Chris Ciovacco of Ciovacco Capital Management, joining us from Atlanta for Stock Charts in Redmond, Washington. I'm Dave Keller. Be well, stay safe, have a good night. Hey, Jerome. Yeah, no, thanks for the call. I think you're going to be fine tomorrow. Take a deep breath. Yeah, do great. I think keep rates the same. Why not, right? Or raise them a little bit. See what happens. All right. Talk to you later.